Most traders get this completely wrong. They try to be mechanical where they should be discretionary, and discretionary where they should be mechanical. And that's exactly why they get trapped over and over again. In this video, I'll show you how to flip that process. So this is what most traders do. They look at the charts and look for something they know or they heard about, like a single signal or something, a first red day, a high being broken, or whatever. And then they go into a mechanical entry. So they just look at one level or the EMA or something, and once this crosses, they just enter the market. The problem with this, rules don't fix a bad idea. A mechanical entry is not edge. This leads typically to getting trapped, because what the market makers know is especially the mechanical entry criteria. So the critical point here is they are using rules to execute weak ideas. What are the experts doing? They have a mechanical trade idea. So what you need to see is that before the market opens, you have all the time in the world to do all the analysis in the world and to get all the help that is available to filter down the best setups. But once it then comes to the execution in the final moment, this is where your intuition kicks in. Timing, levels, behavior of price, and especially, is someone already trapped? So professionals build the idea with structure and then execute with judgment. Execution is not just the signals, it's timing, levels, behavior of price. So you need to flip the process. This is what you are about to understand. And honestly, this is where most traders get it completely wrong. Ideas are mechanical. Trade ideas are not random. They're not based on what you feel in the moment. Your system, your structure defines what you should even be looking to trade. So this is very mechanical and very rule-based. But then execution is discretionary. That's a different game. That's where context, timing, and alignment comes in. Two traders can see the same setup, and one takes it, the other one doesn't. So edge, in the end, is this filtering. This is the key. This is the real edge most people miss. It's not finding more trades, it's filtering them better. So not every valid setup should be traded. So the goal is simple. Plan mechanically, execute with discretion. To really understand this, you have to understand how trading mastery actually develops. Level 1, the system. Level 1 is simple. You trade a system. This is what gets you into the game. It's simple, but it's not easy. So you have to train yourself to follow your rules. You need to have rules in the first place. And the bad news about this is only something that gets you into the game. This will not make you a lot of money. Then number 2, intuition. This is where most people want to be. This is what creates consistency, knowing when to act and when not to. And then level 3, the beliefs. At the top, this is what ultimately determines your ceiling as a trader. But here's the problem. Most traders try to skip to intuition way too early. They haven't built a solid system yet, but they are already trying to feel the market. So this is where trade ideas actually come from. And it's not intuition. Signals. Most traders start here. Signals, a breakout, a level, an indicator, but signals don't give you trades. They just draw your attention to a single pair for a session. But what actually matters is the story behind it. The place, how price is moving, breaking, failing, trapping. That's a sequence of different signals and elements that point into a specific direction. And then especially the setup. From that story, a setup forms, and the setup defines the trade. It's not a single level, it's not a single signal, it's a sequence of events and a pattern, especially on the day and into the session, that confirms being into your personal playbook. And then it comes down to the trader. The trader executes, and only then intuition comes into play. Trade ideas come from structure, not intuition, and then it's up to the trader. So if trade ideas are mechanical, then execution becomes discretionary. And most traders misunderstand what that actually means. Discretion is not a random thing. It's not gut feeling. It's knowing when not to take a trade. A couple of reasons. First, it's too early. That's the first major mistake, taking trades too early. The market is still building liquidity, structure isn't fully developed, or you're just early in the session. So you're forcing a trade before the market is even ready. Then, after a move. Second mistake, chasing after the move. Impulse already happened, the setup is already gone, liquidity is swept. That means you don't have a setup left. So you're trading after the opportunity, not before it. Then, and this is actually the worst one, 50-50 conditions. Conflicting information, no alignment, price is stuck in a range, there is no real edge. This is just noise. So, discretion isn't about taking more trades, it's about sitting on your hands when there is no real opportunity. And this is now where it gets interesting. Even when a setup is confirmed by your system, that still doesn't mean you should take the trade. A valid setup is not enough. Contexts decide if it's an actually tradable setup. So, these are the reasons to skip. Number one, range too narrow. That means no real opportunity. So no real space to run for the trade. The next levels are already right in front of you. Second one, extend it on the lower time frame. So I always look on the 5-minute and the 15-minute. If you're late, if the move already happened, if you're already in the third breakout of a 15-minute or a 5-minute bar, then the next pullback is already imminent and you need to wait. Or timing off. So you might be right and everything looks good, but it's just not at the right time rotation. Every 15-minute, every 30-minute, every 1 hour, watch the clock. New traders are entering the market and you never enter right before that. You want to see what these guys are doing. Do they trap or do they continue? Wait for that and then take it from there. Number 4, lack of parabolic pressure. So you always need some kind of coil before a move if you want to have full conviction of a follow through. So peak formation high, peak formation low, a coil over a couple of hours maybe, and this then unloads into your move into a range expansion target. If it's just working higher, it can turn around any moment. Then it's getting really interesting, and there is intuition absolutely critical. Too obvious. That's especially true for reversal trades. So if everyone sees this, if the pattern is absolutely clear, guess what? The market makers know that everyone takes that trade. And this then will be the trap. So always ask yourself, that's the 2 last questions. The first, is this trade too obvious? If everyone else is doing it, you are not taking that trade. The last one, no trap. That relates directly to this one. If no one else is trapped, who's going to push price? So what's the liquidity that's needed for the next move? So if there is no trap yet visible, then guess what? You will be trapped. So always ask yourself, if you look at the charts, and that's where intuition is absolutely critical, who is trapped and is already someone trapped in the other direction? So all of these look like good trades in the moment, but they are actually positioned to fail. And this is where your edge really comes from. Filtering out the trades that look good, but shouldn't be taken in the exact moment. So let's look at an example of the trap. So let's make this practical. Whenever I look at a chart with a confirmed setup, I'm not asking where do I enter. I'm asking who is trapped. So how to do that? Number one, assume manipulation first. Don't assume the move is real. If the market is breaking out, don't think about should I take that? Is it now moving away? Always assume it's trying to trap traders. That needs to be your first idea. Then you are on the safe side. Number two, let traders commit at obvious levels first. So if price reaches an obvious level, don't act right away. Let them buy the breakout, let them sell the breakdown, let them be wrong first. Then you are safe. Number three, after this happened, identify who is trapped. Now the question becomes, who is really stuck? Who entered too late? Who is now forced to exit? So for example, it hits a level. Once it hits a level, you don't know yet what's going on. Often, many people are buying the low. So if you sell that right away, then you will be stopped out. If you buy that with all the others, it might be manipulated up first, but then the market makers see that people are buying the low and that they dump it. Then these guys are already underwater, maybe even stopped out, and then you're down here. The question here is now, is this a stop hunt and it's pulling higher? Or is it just a first mouse move that pulls a bit back and then continues? The answer is, you don't know yet. So you have to wait. Then price often pulls back to the level. And then once you get the engulfment here, and these guys are trapped again. So one trap, second trap, and they pull away from here. Then you have the liquidity for the move. And then you take the other side of the trade. You let them commit in the wrong direction, and once it's clear that they are in the wrong direction, then you take the other side. So you see, even if you get the trade direction right early, you still will be stopped out. So you need to wait for all of this drama to be happened, and then you take the other side of the trade. The key is, this isn't something you can fully rule-based how you think that's true. This really needs a read of the situation. Every one of these situations is individual. It's unique. This is wargaming. It's really who blinks first. And this is where your rules stop and intuition begins. So now let's look at a real chart example. I give you now two examples on Nasdaq over the last couple of days. It's two trend trades, one that I didn't take intuitively after it confirmed, and one that I did take. And we can discuss a bit the differences. So what you see here on the chart, everything that's shown here is done by my trend predator indicator. The trend predator indicator is a mechanical system that completely automates my trading system. So it tracks multi-time frame alignment over the most important time frames and gives me the bias. And then shows me what setup is allowed. It shows me the context here, uptrend, green, so a non-conflicting, fully aligned uptrend. And the setup that is allowed here is a breakout continuation, low-hanging fruit trade. So in theory, the setup is already confirmed. And we only have to look on the lower time frames how to get into this potential long trade. So what you see here is the days are the blue boxes. So this was an outside day that closed in breakout yesterday. This is very bullish for the moment. And here you see the different breakout levels. So price is always in a box. We have a month that is in breakout. We have a week that is in breakout. And now we have a day that is in breakout. As we are trading above the daily breakout level, we look for continuation longs. So let's look how this behaved into the session. So now, right before the entry window where I start looking at the charts, this box is the open box. So that's the first 30 minutes trading after New York Open. And you see it pushed higher and came now back, but it's in breakout of the 8-hour. So that's also one level I'm looking at. And that's my mechanical system, looking at all of these time frames and the bias, and look if they are overextended. And then here above, in a very mechanical way, it flashes me the signal that is allowed. So here the breakout continuation would be allowed, and the only thing I am considering from here is, do I get the entry? And for this, as we discussed, I really want to see a parabolic situation or a significant short trap for a long entry. So what we see right away is, yes, we have full alignment, but it's just higher highs and lows coming into the session. There was a shallow trap right at the open, but this is not very convincing for me. Then it broke up and now it retests. And let's now see how this trades and aligns with criteria. So I typically look for trades as it breaks out of the open box. So that's like a opening range breakout logic. So if this breaks out and we look at the time, it's 10:10. But I only enter trades with 10:15, 10:30. So after the 15-minute rotations hit. So if I have a 10:10 breakout, then I don't like it much. This is already a rule, but there is a lot of these rules. So you really need to have intuition. You could also say, now this is breaking out, everything is aligned, I just follow this move. I didn't. I just didn't like the timing. Then you see the next candle, the 15-minute candle, locked in a high for the moment. So this is, I just don't like that. So I skipped that. Even though the next candle pushes up, for me, there's no significant short trap yet, and now it's just making higher highs and lows. That's a front side trending move that can turn around any moment. To get into such a trade, I really want to see a significant short trap. So I passed. Then it works a bit higher, and also you see 1, 2, 3 breakout candles now on the 5-minute, and now it's stalling. This is what you often see. Then it fails here at the high. That's the next rotation. That's the 30-minute rotation, and that's exactly the point. So once you don't have a convincing breakout with time rotations and parabolic pressure or a trap from here, then the risk is that it turns around with the next rotation. And this is exactly what it did. Prints a little M pattern here and then dumps further down again. So this is then the retest, and it's coming to the end of the session. That's my window where I typically trade, so I'm not really interested from there anymore. Normally this would be then the entry I would look at. So if you then have a higher high and then this significant push down, you see this 3-5-minute bars back into the open box high level, a retest, and then a switch bar. This is a massive short trap. So people really think now it's dumping, but it's not following through. This is with time rotation. It's the 1-hour rotation. Immediately the next 5-minute bars turns around. This would be a potential entry. So, and then from there, it just runs on. My typical target is the 1x of the open box. So this would have been the trade. The first breakout trade here, I just didn't like, and the intuition kept me out of this trade, and it was exactly the right decision. So now the next day, 15th of April, again Nasdaq. There you see what happened yesterday. So there was massive follow through with this move, and it closed at the extreme. Very bullish, but on the other hand, this is a very strong pump. We see here is the third day of breakouts. So you see it here, 1 day, 2 days, 3 days of breakouts, and now working into the high. So many people would say now this is a lower low, and we are looking for a reversal trade back to the breakout level. But we don't know. I mean, that's a 50-50 situation, and we really have to wait until we have full alignment. So we see here, for the moment, we don't have a setup. So the mechanical part of my system is not decided yet, because the 8-hour level is in a fake out low, the day is in a fake out high, and the higher time frames are bullish. So that's a conflicting situation. It's a potential reversal situation, but it's not resolved yet. But we know already, if this reclaims this daily level, then this flips bullish, and then we are in a bullish situation again. If this convincingly drops down here, then the lower time frames all become bearish, and then it potentially dumps. So first we have to wait for the mechanical system to confirm a setup, and then we come back to the entry criteria and to the discretionary entry. So let's see how it behaved into the session. So again, the start of my trading window, what happened? You see here we are in breakout, all aligning. That's what we said before. Now the system mechanically confirms the setup. Yes, we are in 3 days of breakout. That's overextended, but everything is aligned, and the mechanical part of my systems allows a breakout continuation low-hanging fruit trade. So now it's up to me. I have the open box, and we are at the high of the open box. So do we like that now? So now we look at price action, and we see the open, New York open, immediately pushed up, hit this 8-hour range up here, and then dumped for almost 100 points. See this massive bear candle here at 940. Back down. This, I'm very sure a lot of people used as a reason to short. So New York open pushing up, one more hit of the high, and from there a massive death candle, people thinking now it's dumping, that's the reversal signal. So many are entering their short positions. What happens? The next 5-minute bar immediately pushes up and traps them. That's the short trap. This is a massive short trap, and that's exactly what I want to see. And then from there, I'm still a bit cautious, because it already pushed 3 5-minute bars up again into this 1-hour time rotation. So I'm still a bit cautious and observing. And you see the next 5-minute bars, that's my typical entry bar, the 10:05. This immediately pushes back. So we are still above the 8-hour breakout level, but now we have an open box fake out high. So that's for me conflicting for now. I don't like that, but it's working back down. So this is another little short trap. So then the next candle wicks down one more time, another trap. You see that? So we have 1, 2 wicks down, and then the 10:10 candle pushes up, and we get to the 10:15 entry. 10:15 at the level, and then for me the classic entry for me is the 10:20. So as this candle here rolled over bear bullishly, this is my entry. So that's my trade. Then I have everything I like, and it's not easy to put real rules around that. I mean, there's always rules. I want to have the short trap. I want to see the right candle pattern. I want to have the time rotations in my favor, but that's a lot of stuff. So in the moment, there is really intuition that's necessary to do that. Then for me, the execution of this trade is relatively simple. The target is the open box 1x right here. And then I put the stop loss a bit back, maybe within the 8-hour level in a conservative way to give it a bit of room. And then as it rolls over, I just lock in here as a target the 80 points to the open box 1x. And then I let it run from here. And you see it's working up, and it hits the high exactly with the next 1-hour time rotation into the end of the hour. So 45 minutes, and the trade just runs to target, and that's it. You see the difference to the trade before. Here we had a parabolic situation. It was coiling sideways. It was trapping the lows. then it pushing up, trapping one more time into the rotation, and then I take my trade. Of course, you have rules around that, but you really need intuition to be sure that you don't want to skip that trade. So, after everything we just went through, this is really what it comes down to. First, ideas are mechanical. Your trade ideas are mechanical. They come from structure, from your system. That part should be clear, repeatable, and 100% rule-based. Then, execution is discretionary. Execution is where most traders get it wrong, because entries are not just signals. They depend on context, timing, alignment, and that requires judgment in the very last moment especially. Then your edge in the end, this is the strongest insight, your edge is in filtering. It's not finding more trades, it's filtering out the ones that you shouldn't take. Not every setup should be traded. So, plan like a system and then execute like a real trader. Most traders never understand that. Now you do.